Okay, Assalamualaikum warahmatullahi wabarakatuh and a very good day. Today I'm going to to deliver to all of you is actually the topic today is Introduction to Real Estate Finance. So this is the first chapter on the property finance. So we take a look at the content of this chapter. We will be talking about the legal concept, financing notes and mortgage, and interest factor in financing. For the legal concept, of course, property, we're going to learn about property right, the estate, two general classification of estate, a freehold estate and leasehold estate, interest and easement, and meaning of the title, deed and method of title assurance. So property right and estate is very important to understand both of physical nature of the property right being acquired while making a real estate investment. Many legal terms currently used in real estate business that involve from the English common law, we serve as a basis for much of the property laws currently used in Malaysia and Commonwealth country. So the real term of real estate come from a terms reality. And for centuries, the man of land and others thing permanently attached. That latter include immovable things such building and other structures. Either item not considered as a reality has been designated as personal. For example, in the intangibility asset and movable asset. For instance, automobile, share, stock, bank, cash equivalent, and so on. So you can read through over here the property right. We're going to look at a certain right, must be a right on the particular asset, and include the right to control, to occupy, to develop, to improve, to exploit, and pledge and lease the right of the particular belonging of the particular assets. So in terms of real estate, used to refer to things that are not movable, such as land, improvement, permanently attached to the land and ownership right associated with the real estate and refer to the real property. So it's important to distinguish between physical real estate and ownership right in the real estate property because many parties can have a different ownership right in a given parcel of real estate. For instance, a strata property. So property right as a right of a person to the possession, use, enjoyment, and disposal of his or her property, and enjoy the same degree or the same right and control over the use, in turn, and receive payment for the sale of such interest, and this interest to be extended. That is, value can be determined, may also be bought or sold, used as a collateral to the loan. The value of the particular parcel of real estate can be viewed as a total right individual that are willing to pay for a flow of benefit associated with the possession of the particular right of the property. So right have a value to lease. This right has value to lease, and even though the term of lease is fake, and in exchange to the right to use the property, the lessee will willing to pay the rent for the term of the lease. So there's two general classification of estate based on the right and based on the possession of the end use. Based on the right is the estate in the possession versus estate not in possession, a future possession. So two broad categories of estate can be distinguished on the basis of nature right occupying, accompanying the ownership of the such asset. Estate possession, a present estate in the land entitled to its owner to the immediate enjoyment of the right to that particular estate, and the right not possession in the future of the estate. And in other hand, it can be conveyed to the right of the estate until sometime in the future, and if that particular time is reached, for instance, the estate may not in possession, in other words of sayings, the present, the future possession interest of the property. So based on the possession and use, a freehold versus a leasehold. So there's two general types: freehold estate and a leasehold estate. Freehold estate is lasts for indefinite period of time, and there is no definite certainable date of on which the estate is end. And while leasehold estate, on the other hand, expired on the defined date. Okay. Or meaning of the title, you need to know about the meaning of the title of the estate. The title is abstract term frequently used to link the individual or entity who own the property to the property itself. The document, record, act, and proof of ownership. And the abstract of the title is a historical summary of the publicly recorded document that affect the title. The quality of the title convey from a seller to the buyer depends upon of effect of this document have upon the seller rightful possession of his or her property. Ownership, proof of ownership, and the title. Okay. Meaning of the title is a deed, a matter of title insurance, for example, we can through, and the mortgage, financing notes and mortgage. Mortgage instrument, what is the assumption of mortgage? Acquiring a title and subject to the mortgage and financing source and land contract. So mortgage instrument, a mortgage document is created in a transaction whereby one party pledge real estate or real property to another party as a security for obligation owed to the party. A promissory notes is normally executed temporarily with the mortgage, and notes created the obligation to repay the loans in accordance with the term, and it's secured by the mortgage. The element essential to the existence of the mortgage are the obligation to pay or perform and pledge of the property as a security that for the obligation. In general, when the loan is made by the borrower to the purchaser of real estate consisting of the existing property and improvement, it referred to as a purchase money mortgage. This is in contrast to construction loan made to a refined existing loan, and so on. So assumption of the mortgage is a deed. The deed, after specifying the nature of the mortgage with incumbent of the property, and will contain a clause to the effect that the guarantee assume that it will agree to pay amount of obligation owed to the mortgage as a part of consideration for the conveyance of the title. So if the property is sold with the loan assumption and a new owner default on the loan, the lender can hold the previous owner liable unless the previous owner was released from the debt. So interest factor in financing. So we're going to learn about interest factor in financing, future value of single amount. We're going to learn about present value of single amount, periodic payment of annuity, present value of annuity, sinking fund annuity, future value of annuity, determines the loan repayment, determine the loan's balance payment, and we calculate the effective annual yield for the series of cash flow, and we will define what meant by the internal rate of return. So what is the concept value of money? The time value of money concept is the sum money in the hand today is worth more than the sum of money, the same sum in the future. So before we going to learn about the future, the present value of money, the present value, we need to understand the compounding method. We compound the present value in order to get the future value. And if we were to know the future value, we want to know the present value, we need to discount it. So look at this future value concept. What are the future value concepts? As I said just now, we want to know the future value. We have to compound the present value to the future in order for us to get the future. So, for instance, we have 10,000 invested today. Like say is the 1st January 2017 at the interest rate of 5% at the end of year, for instance, end of the year of 31st December 2017, this investment will bring about how we want to calculate it, the present value. The present value is 10,000 with the I as interest rate of 5% and N the number of year. So the future value would be utilizing the future value present plus 1 plus I to the power of N. So we can take a look here. We utilizing this formula, we're going to get at 10,500. Okay, then what is the present value concept? Present value concept is we know the value in the future and we want to know what is the present value now. So in order to do so, we have to discount the value of present that going to be in the future to the present. So by then we have to, like say, the present value that's today is 1st January 2017, for which the investment will bring about, like say 21,000 in future at the end of 31st December 2017. We are now in 1st January 2017. We are being promised that we're going to get an investment that was 21,000 at the end of 31st December 2017. So assuming the interest rate is 5%, so what we need to do is actually utilizing the present value formula, that is present future value time the formula of present value is 1 over 1 in the bracket 1 plus I to the power of N. So we're going to get over here 1 divide by 1 plus in I to the power of N, that is 1 year. I is 0.05, that is 5%. We're going to, and we time the future value, this is a future value, we're going to get about the amount of it, right? Okay. This is the concept of present value. How we want to get the present value. Okay. Well, this is single. Then we move to the single compound amount, or we call it SCA. SCA. Single compound amount is the future. We're going to get the future value. We're going to get the future value. So present value times single compound amount. Single compound amount. So this is a present. That is the future. This factor may be used to determine the single future amount to the single present amount for the interest rate of I for N period. So SCA present a single future amount that is present value in the future amount and the future in the present amount. So the future value is to be discounted. It's amount to be discounted. So future value, well, future value of a single amount. How we want to know the future value of a single amount? So present value time 1 plus I to the power of N. 1 plus I to the power of N. For instance, over here, Mr. Ning invest 100 ringgit today, in which the investment promised to provide interest rate of 5%. How much is the future value of the investment after a year? So how we want to do it is we have to use the formula of PV equal to FB equal to PV times 1 plus I. So PV is the present value time 1 plus I is 5% and N is 1 to the power of 1. So we're going to get the future value is 105 ringgit. Okay. Single present amount. Single present amount. Single present worth, that's PV. PV equal to 1 over to 1 plus I to the power of n. We're going to get the present value. We know the future value. Now we want to know what is the present value. So this is the amount in future that we have to bring it today. So looking at the graph, this is the amount that we have here. So we have to discount the future value to the present, right? So how is it? Look over here. This is the how we were to do calculation. Mr. Nick make investment today, that is 2021, for the investment that will bring about 120 in future at the end of 2000. In a 2 years time, Mr. Ning going to get 120 in the future. So assuming the interest rate is 5%, how much is the present value today? So what we need to do, utilizing the present value formula, that is future value time 1 over 1 plus I to the power of n, 1 over 1 plus 0.05, that is 5%, to the power of n is 2. So we're going to, and we time the future value, so we're going to get that 108 ringgit 84 cents. That's the future value of the investment that is promised to us, 120. So from here, we know what is the exact amount of our present value. Okay. So periodic payment. What is periodic payment? Periodic payment is the factor that will be used to determine the single future amount of a single present amount for the interest rate I for n period. N period. PP, that's the formula is PP, periodic payment. Periodic payment represent the periodic payment amount of a present value. The present value is a present amount. So usually we're going to use PP, this formula, when we want to determine the installment, yearly installment payment of a particular loan or something, right? So looking at this is how we were to do it. Okay, let's say periodic payment. Let's say we're going to buy a cost of new lighting system that is 100 or 1,100, paying this amount to be spread over 10 years through a borrowing and repayment annually. How much is actually we need to pay yearly? So we're going to have that particular cost of new lighting 1,100 is to be spread over 10 years. We will finance over 10 years period with the interest rate of 7%. So what we want to know is actually PP, or we call this the formula is PV time 1 plus in the bracket 1 plus I to the power of n, and then it over 1 plus I to the power of n minus 1. So this is a formula. What is the repayment amount annually? A. So how we were to do it? So we were to use this formula in order for us to know what is actually the periodic payment for the loan amount that we committed. All right. Okay. Present worth of annuity is a formula that may be used where present amount of I is written in n equal periodic installment. PWA is represent uniform present worth. A represent the uniform amount of money in the such period, and P is represent the worth of the installment is the unknown. So look at example of present worth of annuity formula. Okay, it is anticipate, for instance, it is anticipate an amount of annual contribution of the medical card insurance for is 50 ringgit annually for 10 years. 50 ringgit annually, this is the amount annually for 10 years. So we want to know what is the present worth of the annuity. So we want to know what is the present worth of the annuity. Now, interest rate is 7%. So utilizing this formula, that is A, this is the annuity, that is 50 ringgit, and this is PWA formula. PWA formula, we want to know the present worth of annuity, right? So we want to know what is the present worth annuity. We use utilizing this formula, that is 1 plus I to the power of n minus 1 over, okay, I times 1 plus I to the power of n. So over here, how is we want to calculate is 50 ringgit is the annuity, annuity yearly annual annuity amount that we're going to pay. And we want to know what is the value of that particular investment in 10 years time. So we want to know what is the present worth of annuity. So times 50 ringgit time 1 plus I, that is 0.07, that's the interest rate, time to the power of n is 10 minus 1. Then over the I, that is 0.07 times 1 plus I, that is 0.07, that's the interest rate, to the power of 10. 10 is n. So we're going to get like 351. So meaning to say, like say this, we spread over an investment of 50 ringgit every year for the period of 10 years. Actually, the amount of the present value of the annuity now is actually 351. Okay. Okay, another one is Uniform Sinking Fund, or you call it USF. Uniform Sinking Fund is 1 over 1, sorry, I over 1 plus I to the power of n minus 1. So usually over here, we want to know, what is the sinking fund amount. Okay, look at the example. If the education insurance, we want to know what is the education insurance. Okay, this is the, right? We want to know what is the education insurance anticipate to be worth of 20 ringgit. There's a future value, 20,000 in 10 years time in future, assuming that the I is 7% interest rate compounded. What is the allocation that the investment need to be put aside each year? So utilizing this formula, that is annuity, we want to know what is the annuity, the future value that we want that particular amount of money to be ready for the education. Insurance is 20,000, 20,000 times the I, we over here we have 7% over 1 plus I, 1 plus I is a 7% to the power of n is 10 years, 10 years, then minus 1. So we're going to get 1,448 ringgit. So by investing, putting the fund 1,448 ringgit in the education insurance over a period of 10 years, at the end of the 10 years, we going to get 20, the future value is 20,000. 20,000. Okay, another one is uniform compound amount, or you call it UCA. UCA factor may be used when periodic installment invested at I interest amount of future sum of money that will be determined. Use UCA, or uniform compound amount, represent uniform compound amount, represent of the uniform sum of money in each time period, that is F, the future sum if of money is unknown. Okay, let's take an example of this uniform compound amount, or we call it UCA. For example, over here, the engineer wished to allocate 100 ringgit. 100 ringgit is A. 100 ringgit is the annuity amount over a period of 10 years for his retirement. So he want to save, he want to know what is the future value if he were willing to put a money that is 100 ringgit over a 20 years period for his retirement needs, assuming that the interest rate that we are going to employ is actually 7%. So what is the amount at the end of 20 years? So we will take a look. Like say this particular engineer put a 100 ringgit A. So utilizing the UCA, UCA formula. UCA formula is 1 plus I to the power of n minus 1 over I. So over here, utilizing of this particular formula, we're going to get 4,100. Meaning to say, if this engineer putting his money 100 ringgit every year for the period of 20 years and utilizing the 0.07 the interest rate, he's going to get in future the value of the money going to be the 4,100. Okay, and over here he's going to get 4,500. So how we want to do this is actually single compound amount. Okay, when we want to use all the formula that I already explained, single compound amount is to predict the future value of investment after years. We're going to use single compound amount, or we use it as SCA. The interest is 1 plus I to the power of n. We want to predict the future value. Meanwhile, if we want to determine on how much the present value today of the promised future value amount in future, we have to use the single present worth, or we call it PW. PW, the formula is 1 over 1 plus I to the power of n. So in this formula, we employed present. We want to know present value. We know the future value. So we have to time the future value with the present worth formula. That is 1 plus I, 1 over 1 plus I to the power of n. Meanwhile, this is periodic payment. Periodic payment. Periodic payment is another amount, is to determine the single future amount of a single present amount. We want to know what is the single future amount, that is the annuity that we have to pay for a present value amount that we have, we determine now with a periodic payment. So utilizing this formula, we're going to get the single future amount of a single present amount. Okay. Meanwhile, we are using P present worth of annuity to determine what is the present worth of the annuity in future. So we already know what is the annuity. Let's say annuity is 100 ringgit, 50 ringgit, time the future present worth of annuity, PWA. This is the formula PWA. We're going to get the amount of present value. Over here is actually Uniform Sinking Fund, or USF. We call it USF. USF is to determine what is the allocation that will be invested, need to put aside each year for the target future value. So we have a target future value. We have a target future value. This, we want to determine what is the annuity or allocation that we have to put aside every year. So we will be utilizing the USF, Uniform Sinking Fund. Uniform Sinking Fund, 1 over 1 plus I to the power of n negative minus 1. Okay, we're going to get the what is determined of annuity, right? Uniform compound amount, or we call it UCA. UCA is what is the amount invested at the end of the end period for annuity contribution made. So we want to know what is the future value that we're going to get for the amount of annuity that we able to spare, and utilizing the UCA, we're going to get the future value. So okay, let's take a look over here, a few examples. We want to know the future value of a single sum amount. Assume investor invests 1,000 ringgit today, 1,000 ringgit today, which pay 10% compounded annually. What is the expected future value of that deposit in 5 years? Okay, we're going to get the 100 future value of that deposit, that the future present value is that 100 ringgit. The I is 10%, the N is 5. So we're going to use this one, 1 plus I to the power of N, that is 5, time the present value that is given is 10,000. We're going to get RM 1,611 for the future value. Meanwhile, for a present value of a single sum, assuming the company have an opportunity to provide 16,105 ringgit and 10 cents at the end of 5 years. So let's say this investment required 10% of annual return. How much that this particular company need to pay for a future sum? So we want to know what is the future sum, present value now. So we have to we want to know what is the present value now for the future value that is 16,105 and 10 cents. We have to use the present worth. So present worth in formula is 1 over 1 plus I to the power of n. 1 over 1 plus I to the power of n. We're going to get the future value is actually 10,000. Okay. This is example of how we want to calculate the payment of amortization loan, mortgage loan. Assuming this company have a mortgage loan of 100,000 at 10% annual interest, paid monthly and amortized over 60 years. What is the amount of payment of principal of the principal and interest? Principal. What is the installment that this particular investor need to pay? Take a note that this question require monthly payment. So therefore, N in year you need to multiply by 12, and interest rate you need to be divided by 12 also. Okay, take a look. This is the original. This is the original formula. That is, okay, in order for us to get annuity amount, the present amount time 1, the I time 1 plus I to the power of n. And you remember over here, I is 12. You have to time 12. You have to divide 12. And I over here also you have to divide 12. And then n over here you have to time 12. So this formula you need to do it, and you're going to get the annuity amount is the annuity amount is actually 8,877 ringgit 57 cent. Meaning to say, if this particular investment, the future value is the present value, you take a loan of 100,000. The interest rate is 10%, and for the period of the loan is the period of loan amount is actually 30 years. So 30 years you have to time 12, the n, and the interest you need to divide by 12. So you have by calculating it, you should be getting 877 ringgit monthly. While this formula is actually we want to know what is the present value of the annuity. We want to know what is the present value of annuity. Let's say we able to contribute 10,608 annually contribution for retirement plan. This is the amount that we're going to pay yearly, 10,608, and over a period of 30 years. Over a period of 30 years, what happened with utilizing 10% annual interest? The present worth of annuity would be like this, and that's 100,000. We know the annuity amount that we have to pay monthly, and for the period of 30 years, this is the amount of we have to every year we have to pay 10,608, and we utilizing 10% of interest rate. We should be getting the present value of annuity is 100,000. Okay, utilizing the USF, we call it USF, for a single fund annuity payment, assuming that this particular investor want to accumulate 61,000 in 5 years time, and utilizing 10% of interest rate, compound annually. So what the amount should be every year? How much is actually the amount that we have to invest? Okay, utilizing this is the amount, the present value. This is in 5 years that we have to accumulate. We want to accumulate. We want to know what is the annuity. So utilizing this formula, that is I interest rate over 1 plus I to the power of n minus 1. So we're going to get A. A is 10,000. Future value of annuity. Assume over here, investor invested 100 ringgit at the end of each year in an investment that pay 10% compound annually. What is the expected future value of the investment in 5 years? So utilize, we have to use the USA. Uniform compound annuity. So utilizing over here, we should know that present value of the annuity that we're going to pay like 1,000 ringgit in 5 years time. We're going to get the 6,105. Yeah. Another method is actually we are using the loan payment, or we call loan repayment. The formula is PMT. PMT is actually the formula equal to interest rate time present value over 1 minus in a bracket of 1 plus I to the power of negative years, that is n negative. We're going to get 8,770 ringgit 57 cent every monthly. This is the amount of annuity, that is installment, the same installment. It's actually similar to this one, except that this one is actually we are utilizing years, monthly. We want to know monthly. This is we want to know yearly. Okay, the different. So okay, I'm giving you an example. Determine, okay, example, the balance, okay, determine the balance of the mortgage loan, 100,000, mortgage loan 100,000 for 100,000 at the 10% annual interest, pay monthly, amortize over 30 years at the end of 4 years. So at the very first place, this particular loan, we need to determine what is the annual subscription, annual subscription of the particular investment. Okay, for instance, at the very first place, we need to determine what is the annual installment, what is the installment, monthly installment of this particular loan. Mortgage, the mortgage loan value is 10, the mortgage loan is amounted 100,000 and the interest rate is 10%. It's actually loan for the period of 30 years. However, maybe in this case, the loan will be would like to be finished. They want to know what is the balance of the loan and after 4 years, after 4 years of the loan period. So what happened? We have to do 2 steps over here. First of all, we need to know what is actually the installment. First step, we need to know about the installment. So in order for us to know the installment, we'll be utilizing the PMT formula. That is, the formula is interest rate time the present value over 1 minus 1 plus I in this case is 10%, to the power of negative years. Negative is 30 years. So over here, interest rate, that is 10% over, they have to be divided by 12 because we want to calculate monthly. And the present value is 100,000. And then we have to settle it first. And then we have to divide it over 1 minus 1 plus I to the power of negative n. So 1 plus I I, we have to divide it, that is I is 10% divided by 12, and then we have to power it with a negative of n, and n in this case is 30 years time, 12 negative, negative years. So we're going to get the calculation as in this case the installment monthly will be paid 8,877 ringgit and 57 cents. Then when we get this figure, able to get this figure, we have to go to the next step. You'll be utilizing this figure, the installment figure, in order for us to know what is the balance in this case. So when we want to know balance, we are utilizing another formula, that is B. B negative equal to PMT times 1 plus 1 minus 1 to the power of I negative n minus k. K is the how many period, how many years that already the 4 years of the loan, right? So over I. So over here, when we utilizing this formula, we have to do step by step. Yeah? Then we should be getting 97 404 97,402 ringgit and 22 cent at the end of 4 years and of the loan period. So we want to know what is the balance of the loan. We want to know the balance of the loan. All right. So I think that's all for today. Thank you very much.